Thanks everyone for being on this call, because I know it's been organised at short notice. Thanks to Equity Developments for setting it up. I was keen to speak to our sort of retail investor base after the RNS on Friday. Really, I suppose fundamentally to apologise for I really don't like disappointing investors. Obviously, institutions invest a lot of money in us, so I'm kind of that's a problem for me. But I'm also always very conscious that retail investors, it is your money, it is money that you've earned, you've saved. So I was very keen to have this call. Chris Dent, our CFO, was on holiday this week. That was something that was already pre-planned, but I didn't really want to sort of defer the meeting till the call till next week. I thought it was important to speak to retail investors as soon as possible. In terms of what's happened, well, we are here. We are pretty devastated, to be frank, because really since January 2020, we've to some extent of defied gravity. We've dealt with a succession of external crises. Going back to Jan 2020 with our factory base closing, then customers closing, then the shipping crisis, cost of living crisis, and then we, for the last couple of years up until very recently, we've had retailers who have been significantly overstocked, and we've traded hard through that extended period and delivered increase in sort of revenue profitability, and we've kept those dividends going. We just couldn't quite get there in FY24, and it really does come down to Q4. When we updated just over a month ago, when we had our interims, we were assuming that Q4 revenues would be about 1 or 2% higher than the previous year. So we were assuming some very modest growth in revenue for Q4 year on year. That was a bit better than, say, H1, where we were -4%. But we didn't feel in any way that it was a particularly aggressive assumption. We'd seen sort of retailer inventories normalise as of January, really. We'd seen consumer confidence sort of on the way up, albeit from a low point. And we'd seen, sort of steady, really improvement in disposable incomes, which tend to benefit GM businesses like ourselves. Food inflation was dropping. That tends, we've had a long period where, we've had wage deflation combined with high food inflation, which is a pretty toxic environment. You're talking about a smaller share of a smaller basket. We could see, we believe we were entering into a period where the basket was going to be larger because wages were going up in real terms, with maybe more of a share for GM because food inflation is dropping. And we still think fundamentally that's what's happening. The retail inventories are normalised, but we're not going to get the benefits of that until FY25. We were hoping for some benefits earlier in the year during this final quarter, but it's going to be fundamentally a benefit to FY25. But what we have seen, for reasons which aren't altogether clear, is we have seen a slowdown in consumer spending. So despite the fact that consumer has more money in the pockets, for some reason over the kind of spring period, we've seen them sort of holding on to that money and not deploying that in store or indeed online. Most commentators, most analysts are presenting this as a kind of weather-driven blip. I sincerely hope they're right. But at the moment, because we can't explain it, we thought it sensible to take the more cautious view that it is maybe more of a trend than a blip. We have seen it having an impact on what we call our near-term sales. So things like our call-off accounts, things like our online, and things like our sort of regular stock accounts, the accounts which are closest to consumer demand. So when consumer demand moves, so they tend to move quickest. Other parts of our business, like FOB, move more slowly in response to consumer demand. And what we've seen is that part of our revenue drop, and we saw this really most clearly we saw some of it in March management accounts, which we reviewed in the middle of April. And we've seen it more clearly in the April management accounts, which we had sight of Wednesday last week. So yeah, we've looked at this drop in on near-term revenue. We've listened to the reasons which people have given as to why it is. We're not quite convinced that they're right, and we've assumed it's going to be a trend, and therefore will pull down Q4 revenue. So instead of that very modest 1 or 2% growth, we're looking at, depending on which analyst is doing the work, it's probably more like a 7 to 8% decline in revenue in that quarter. It's also had a very direct impact on margin, because those kind of near-term revenues tend to be higher gross margin. They do come with a higher operating cost, but of course that operating cost is already deployed. So what we are losing is we're losing the revenue, and we're losing that better margin, and therefore we have taken a more cautious view of our margin over Q4. And it's that combination of lower revenues from those sort of near-term sources of revenue that we have, and the margin impacts that's had, which has led to the downgrades on Friday. We are more optimistic about FY25, and let me tell you why. We are seeing more normalized ordering from larger retailers off the back of their inventory levels, after a couple of years really being back at something approaching a sensible level. So that is already having at this very early stage, having a good influence on our FY25 order book. And I think the view we have is if the commentators and analysts are right, and the second half of this calendar year will be strong for discretionary consumer, then that's an upside. But even if these current more difficult consumer conditions continue, the tailwind from the benefit of more normalized ordering arising from more sensible levels of inventories in retail, we are very confident will outweigh whatever headwinds that might represent. And let me explain why with a simple example. If we have a retailer that's overstocked, they don't just reduce their intake by 5-10%. They basically shut the doors for a period until their stock normalizes. So often you can see drops of 40-50% for us as a wholesaler. It's often something which isn't kind of fully appreciated as we often look like a retailer, but we are very much a wholesaler, and so that can lead to increased volatility when retailer inventories are high. In a normal year, and when we all love to have a normal year, we have a portfolio effect with the business. So we have some retailers that might be understocked, some might be overstocked, and some might be in the middle. What we've seen since the end of the pandemic, when the kind of volatility of demand led to an across-the-board overstocked, is a very extended period of unwinding of those overstock positions, really from January 22 through to January 24. So we are much more optimistic about FY25. There's good signs of that in our order book, which is why we did update. It is early, so a lot can happen, but so far we're feeling good about FY25. I think also the fundamentals which are underpinning it, I think we do see continuing. We do see that we're through the worst in terms of a return to growth of disposable income. We do think consumer confidence is past the worst too, and will continue to improve. I mentioned those retailer inventories several times already. That correction has happened. So the fundamentals of what we see will drive the order book of FY25. We see are there, and we see that as a much better environment than we've seen over the last few years. In addition, of course, we've got our investment in Europe, and we do see significant growth in our European revenues as we move through FY25. Okay, that was, Hannah, all I had to say. I hope that was reasonably comprehensive. If you have any detailed financial questions, I'll do my best. But Chris isn't here, but I will do my best to answer them comprehensively as well.
Good, right. Well, we'll steer from quantifying what normalized looks like, but a couple of questions here on consumer trends driven by people favouring experiential holidays rather than GN goods in general. Do you have any thoughts to share on that?
Yeah, I mean, I guess the thought I've got to share is I think in a way we're all going to have to take our own view, aren't we, of this? I think that fundamentally, if you're a GM business and you're moving from an environment where people had less money every month and then food inflation was high to one where the reverse is true, that at some point has got to be, it's certainly a more benevolent environment. Now, of course, where will people deploy their spare cash? I think that debate about will it be on stuff or will it be on experiences? I mean, I don't think, who knows is my view. If you look at the market research from earlier in the year, and you ask people what they were planning to spend their money on, right down the bottom was hospitality and dining out. There was the consumer was clearly intending to see, the novelty of getting out after the lockdowns had kind of worn off. Eating out was is very expensive. The service levels are often quite poor. So that was right down the bottom of the list of people's priorities. Right at the top of the list were things like holidays. But kind of in the middle, maybe towards the top half, was investment in the home. So I looked at this and thought, I'll take that. I'll take that after the last couple of years, definitely. And there is certainly some evidence of, when people aren't dining out, they're entertaining at home. That can be beneficial for things like our kitchen business, cookware, which has had a very difficult couple of years, we can see is on the up, and that I think reflects that move. It's just at the moment, this spring has been very tough in terms of in-store and online. And I just didn't, I think, we gave it a month. Okay, that's a blip. We gave it another month. No, hang on a minute. We've got to assume the worst here and factor that into our numbers. I say most commentators are more confident about the second half. At some point, they see these effects starting to come through. I very much hope they're right. I'm just going to, and when I see it, I will have a nice glass of Chardonnay that evening. But for the moment, I think we're assuming the worst in the short term. In the medium term, we're much more optimistic.
Okay. You referred to significant growth in the FY25 order book, giving you confidence, while simultaneously having to adjust FY24 down 4 weeks after the last update. What is the typical mix between long and short lead time orders?
So this is a great question, and I think in moments like this, you always reflect upon what could we have done differently in terms of communication. And I think one of the things I've settled on is the business has changed over recent years, both for, I think, structural and cyclical reasons, in the sense that if you go back to when we IPO'd in 2017, and this is I'm taking very much a high watermark here, 67% of our revenue of our gross revenue came from FOB business. So for those of you who aren't sort of aware about what FOB is, this is where we hand the product over in the Far East, normally in full containers, and our customers, our retailers, do the importation. So it's large orders, ordered very far ahead, and made our order book very predictable. Now, that was perhaps, as the business has grown, its online business, for example, and other elements of our business, that has come down. But this year, it's probably going to be about 20%. So it's quite a big move. I don't think 20% is its normalized level. I think it'll be somewhere between 35 and 40. I think that 20% represents when retailers are nervous about their stock position and they become risk off, the one thing they look to cut first is those big orders placed further ahead, and they want to order product on a more hand-to-mouth, more predictable basis. So I think it won't go back to 67% for structural reasons, but it will move back to, I suspect, 35 to 40%. Now, what that means is, and this is all part of us over the recent years with all the challenges we faced, trading hard, finding one challenge and having to find a solution to it, and having to and if retailers don't want to order FOB further forward, they want to order landed on a more hand-to-mouth basis, we've provided that option to them, and that's helped mitigate the effects of these sort of external crises. It does, however, mean a bit less visibility in our order book, because we do have this sort of more near-term business as a structural but also cyclical large part of our overall mix. It's normally pretty dependable, which is why I think is the reason why I've not I've never raised it in the past. I've never seen it as massively relevant, because it's always been pretty predictable. Not over the last couple of months, last month or two, unfortunately.
Okay, helpful, thank you. A quick glossary point. Can you explain what you mean by call-off accounts?
Yeah, so a call-off account is typically larger retailers. They will say, I use Asda as an example. They will say, we'll list your product for a 6-month period. So we'll go into store. We will take an initial order for the store fill and their warehouse fill. And then as you go through the season, as people buy the product in store, we will then supply and top up their inventory. So as I say, along with online and our regular stock accounts, it is the part of our business which is closest to consumer demand as a wholesaler. Often what they'll do is they will give us access to a portal where we can see sell-through, and therefore we can manage our inventory position. So I don't want anyone to be worried about inventory here. It's when demand moves, we have the sort of management processes in place that means we manage the inventory effectively. As I say, it's normally pretty predictable, not least because we take a cautious view. So if a retailer says, look, you're going to sell 1,000 a week, we'll assume, say, 750 in our order book, and then we'll maybe keep a buffer on top of that. But and that's why it's never really been something we've had to raise previously, because it's always been reliable. Something has happened during the spring in store and online. There has been a sort of a stepped change in demand, which has become really apparent over the last month or so. It's affected those parts of our business which have an immediate impact on our revenue, but at the same time, we've not had benefits in Q4 of the more normalized order placing from lower inventories, which is benefiting more on a forward order basis, FY25. I hope that makes sense. I know there's quite a lot of moving parts in a wholesale business like ours, but I do apologize if it is confusing.
coming through live and clear. Which product lines are responsible for the slower than expected sales?
There isn't any particular. It's we're largely a home business, and it is across kitchen, floor care, laundry. It's pretty well spread.
In the last presentation, you declared that headcount was down from 395 to under 350. Was this via redundancies or attrition, and is it having any impact on the continuous improvement culture?
No, not at all. And it's been very clear. The headcount moves have been very much a sort of bottom up process than a top down. Where we've seen efficiencies, we've allowed typically through sort of natural attrition the headcount. So for example, if we've deployed a piece of kit that means that in a particular area we no longer need 5 people, we need 4. We've allowed that headcount to float down through the normal natural wastage. Some of it is seasonal, by the way. We get our best people during this peak graduate recruitment season we're in at the moment. So when we came back from Christmas, we said, look, we've deployed a lot of we have 900 virtual robots in the business now, which I'd say some people find mind blowing. So we tend to be cautious during peak in terms of headcounts, because obviously we want to that run into Christmas. We tend to keep the headcount pretty stable, because we're looking after the customer, and demand can move quite quickly. When we came into January, I said to all our line managers, look, we're just going to let the headcount naturally move downwards, on the basis that we'll build it back up a bit in our peak recruitment season, which is sort of May, June, July, August. So we do see that sort of 350 is below the sort of structural norm. It will float back up to about 365, I think. But even at 365 going into peak, it's still 30 to 35 heads below what we had in peak calendar year 23.
Okay. Last question, unless anyone out there has any more. Are there any contract criteria, such as minimum sales volume for the Russell Hobbs license? And if you're prioritizing fully owned brand sales, are you staying well above such limits?
Yeah, so I mean, just to say, Russell Hobbs is a very important brand to us. I mean, I know it's typically about 10% of revenue, but 10% of our revenue is still a decent sized number. It's great in terms of particularly in Europe, in terms of opening doors. People see, if people don't know the Belgium Salter brands, they often do know the Russell Hobbs brand. So it does play a particular but very, very important role in the business. We do have minimum guarantees as part of the license. We've many years ago overshot those, so we are well above those minimum guarantees, and so I think even with a decline in revenue, we wouldn't have an issue there.
Great. Well, listen, that's it for the questions. So thank you for that update. It's extremely appreciated, your transparency today. Thanks for all of you joining us at very short notice. And we look forward to further benign conditions going forward.
Yeah. Thank you all. Thanks for your time today. I really do appreciate it.
Cheers.